We're talking about this 4% club. Do you like holding treasuries in this environment?
I do. I think long end treasuries are attractive because, where does the Fed end up? I think we can debate. Are they going to end up at 5.25, 5.5, 6%? But I think what the Fed's telling us is they're committed to that 2% inflation. In our view, the only way you get 2% inflation is through a hard landing. The unemployment rate has to be much higher. The Fed is going to continue on the mission until they slow things down. So I think positioning for a hard landing, whether it's later this year or early next year, implies that those long end rates. So I like owning 10s, I like owning 30s. I would stay away from that front end because it's so sensitive to the end point of the Fed hiking cycle, to how long they stay on pause. But I think 10s at 4%, we added to our long position. I think it's attractive as a longer term play because at some point when inflation gets closer to 2%, the unemployment rate is closer to 5, I think the Fed's going to start to have to cut rates. We think that's a 24 story, but the market, the 10 years should be pricing in your view of interest rates over the next 10 years. So I think 4% is attractive. It's particularly attractive against risk assets because I don't think the broader market is pricing in a hard landing. I think we're pricing in no landing. And so if you get that slowdown that the Fed is actually trying to engineer, I think risk assets struggle, and then owning treasuries, long end treasuries, will be a good hedge.
The fundamental question, Priya, to me is also why does the data continue to come in so strong? Is it because the Fed has not tightened enough, that the framework needs to go further for longer, or is it because we're not perhaps accounting for the lag for this to transition through, the transmission lag?
Yeah, great question. I think this is the macro question we're all grappling with, that, why is the data so strong? I will say there are a couple of one-off factors. In January, you had lower tax withholding. There was a high COLA adjustment to Social Security payments. It was a warm winter. So I think there's some factors which might have boosted the January data a little higher. But bigger picture, your question, I would argue it's the lags. I think policy became restrictive at the end of last year. Within a few months, the economy is not going to respond. I mean, we can debate whether the lags are 12 months or 18 months. They're certainly not a couple of months. So I would say as policy has become restrictive or reached away from a highly accommodative territory, I think the economy needs time to respond to monetary policy. So I think they actually need more time rather than much higher interest rates. But frankly, we don't know. And I think that's why the Fed continues at the 25 basis point hike. I think going 50 will signal that they have a lot more restrictiveness, if that's a word, to add to policy. And I don't know if they're convinced of that. So I think they keep going 25. They respond to data. They respond to how sticky inflation is. But I actually think it is the lags. And we expect once the savings buffer, the consumer has savings. Once the savings run out by the end of the year, I think the consumer then does start to slow down, even with the funds rate at 5.5, which is where we think the Fed will roughly end between 5.25 and 5.75. I think that's restrictive enough. But I think that there is a cohort of investors who think the Fed may have to hike a lot more, and that's why interest rates are rising as much as they have recently.